Good morning and welcome to the QCA Aim to Main webinar. Throughout this recorded meeting, attendees will be in listen-only mode. Questions can be submitted at any time using the Q&A tab situated in the right-hand corner of your screen. Simply just type in your question and press send. I'd now like to hand you over to James Ashton, CEO of the QCA. Good morning.
Good morning. Thanks, Paul. Thanks very much. Good morning, everyone. Welcome to the QCA's first event coming back after our short summer break. And it's a topical one. Just as people settle in, we're really pleased with the number of sign-ups we've got for this. We've had a number of webinars we've done this year, exploring topics such as becoming a B Corp, getting the communications strategy right, and how to get the best out of board performance reviews. They're all on our channel on YouTube if you want to catch up with any of those. And we're very pleased that we've got a lot of members with us, but also some non-members on the call today. If you haven't thought about becoming a member for a while, please take a look. You could contribute to a lot of our policy and engagement work through our expert groups. And also what we're doing a lot of now is political engagement. We're taking more MPs to see more member companies than we've ever done before. I'm on the road in September in Wiltshire, Manchester and Rugby for meetings like that. We find them really valuable for MPs to really understand how a growth, small, mid-cap quoted company lives and benefits their local economy. Also bear in mind our very lively events program, dinners and lunches this autumn. There's a lot of eating to be done on topics such as investor relations, ESG and dates with our fund managers. So coming on to Aim to Main, that is the topic for the next hour. This is something that we saw as really developing as a theme in UK capital markets in 2025, and we thought we should have a conversation about that. We knew people were talking about it. Why is it happening? What's it like? What are the pros and cons? Who's it for? Who's it not for? I'm very pleased we've got two people who know this topic really well joining me. First of all, Stuart Andrews. He's an equity capital markets specialist, over 25 years of experience and currently managing director for global capital markets division at Canaccord Genuity. Welcome, Stuart. And alongside him, James Brotherton, who's CFO of Breedon Group, the FTSE 250 aggregates company, one of the few, possibly the only CFOs who has led this process not once but twice. Breedon in 2023 and Timon back in 2013. James is also a QCA board director, so I'm very much on my best behaviour today, and he's also our representative on the takeover panel. Welcome, James.
Good morning.
Good morning. Of course, this is a three-sided conversation, but we really want anyone that's on the line feed in your thoughts, your questions, and we'll get to those as we go through. These events are far more useful for all if they're interactive. Stuart, let me come to you first. It is a trend of the year. Could you just recap why we're here now, why we are seeing a number of AIM companies thinking now it's time to go to Main?
I think there's it's the push and pull, I would say, of two or three different events. So taking them in order, obviously the government changes around IHT means that there are sort of less benefits to holding AIM through the IHT wrapper, and we're likely to see sort of continuing changes to the AIM investment community around that rule change. It therefore means they're perhaps a less important or going to be less important part, and therefore remaining on AIM because of the IHT break is something that's now less of a barrier to move. So I think that's step one. Step two, I think, is that there have obviously been rule changes around the official list. So they've now come out and scrapped premium and standard, and have basically said we're just going to have equity commercial companies. And in line with that, they basically scrapped an awful lot of their rules, which means that the distinguishing features between AIM and the full list have become much less. There are still some. Key being the ability to transact, in my view, so no more class 1 circulars and the admin that goes with it. And then number two, the the rigmarole around some of the agreements you have to have in place, major shareholders, etc., etc. And I think the third one is obviously they've made it easier. There's the shorter prospectus route that allows you to move. And I think that then combines with some companies believing that they've had their time with AIM. They're now bigger, they're more robust, they are more capable. Certainly some of them are looking to go straight into the FTSE 250. So to finalise the point, my view is we've actually gone back 25 years where we're opening up a much better channel for companies to prosper on AIM, to take advantage of its purpose, and then to progress through the capital market structure. So I think it's incredibly encouraging.
Okay. And is it so encouraging? And who do you think, because there is a sense, I suppose, observing it and talking to lots of companies about this, there's a, I don't know if it's a sense of irony or it seems to be a trend that's taken some people by surprise. The listing rules changes came in just over a year ago, and there was a hope, perhaps a belief, that this was the moment this would get the IPO market moving again. And actually, what's happened is the main contributor to the main market has been those AIM switches. So
I think you have to distinguish there, James, between I don't think easing up the rules is necessarily a precursor to opening up the IPO market. I think it becomes a helpful factor when the demand side has sorted itself out. There's a myriad of reasons we could go into there. So effectively, it's sort of being used now predominantly by people wanting to shift markets. I think you don't see the IPO market come back and take advantage of it in any meaningful sense until sometime next year. Very aware in that statement that all good brokers kick the timeline for the IPO market resurrecting somewhere outside of the time horizon they can be held to.
Yes, yeah. James, what about your thoughts? I mean, are you surprised that we've got to this trend now? Of course, you've done it before. You've done it before. It was as easy as Stuart describes as it is now.
No, I'm not surprised in that I think that the whole purpose of AIM, when it was originally constructed, was to act as a growth market and a different route to capital, particularly for smaller and acquisitive companies. But the idea was always that people would progress from AIM to a main market in due course. I think that the last 20 or so years, as Stuart alluded to, that route became progressively more difficult. And what you've seen over the course of the last 12 months is some movement towards a simpler route to the destination, but also an adaptation of the main market rules such that once you are there, life and access to capital in particular is more straightforward.
There have been some questions I've had about who is promoting this, and I'm wondering whether it really matters. There's a sense that some of the brokers are selling the switch as the place. This is what you need to do if you want to drive that liquidity. There's also a sense that maybe the LSE they want to do this too. Do you sense about where the drive, or is it coming from boards themselves, where the drive is coming from, or does it really matter where it comes from?
I think it's a mix. I think there is undoubtedly a factor of the advisory community looking at the changes that have come through to both the process and the rules at the destination, and coming to boards and coming to corporates and saying, look, if you haven't been thinking about this, we think this is something that is worth you considering. I think if I just take both the Breedon and the Timon experiences, it was also very much board led. It was very much a case of as a board, the two corporates respectively sitting down and saying, actually, in terms of our journey and in terms of our progress, what's the right market for us? So I think in the course of the last 12 months, you've definitely seen a little bit more coming through from the advisory community. But ultimately, the board will have to own the decision, and therefore the board need to drive the decision.
Stuart, what do you think? Where is the conversation originating?
100% agree with James. It's I would say it's a conversation that's really been off the table because there's been no good reason, I think, absent James's experience in 2012-13, there's been no good reason, in my view, to really move from AIM to the full list. It's not really had a driving force. But as I said, there's suddenly 2 or 3 changes, and that opens up the conversation. And I think it's an open conversation between boards, advisors, fund managers. It's the entire community. And as I say, and James, I think, is echoing, I think it's a return to the status quo ante. I think it's getting us to a position where you can graduate, you can have different markets for slightly different purposes, and you're allowing choice again.
Yeah. I suppose we would emphasize that there are some people who say when a company gets to a certain size, it really should get onto the main market. We're very much of the view that, again, it's a board decision. We know lots of companies, of a size, they're really happy on AIM. And we also note, and there are good examples this year. This hasn't all been a one-way street. We've seen companies go from main to AIM. Crichton's in Peterborough, consumer healthcare is a good example this year, and a QCA member. James, is it worth going? Is it worth turning to your experience? And I wonder whether should we take one by one, or is this really all about Breedon, or is the time and one too historic now?
Yeah, I think Breedon is the most relevant one in that it happened 2 years ago. I mean, to put a bit of context around it, Breedon listed as a cash shell on AIM back in 2008. Very difficult at that stage to list a cash shell on the main market, if not impossible. Raised £13 million at that stage to fund due diligence and prospecting for potential acquisitions in the heavy side aggregate space. And over the course of the first decade on AIM, Breedon raised close to £500 million in equity, 350 in straight cash placing, and another 150 million that was issued as consideration shares as a function of the fact that there was liquidity and value in the Breedon stock. And the AIM market gave us a number of key characteristics, particularly in those early days. The most obvious one being flexibility in transactions, and the fact that acquiring really quite sizable businesses up to and including our market capitalization could essentially be done on the basis of the board's approval and without having to go and seek specific shareholder approval. Not that shareholder approval wouldn't have been forthcoming, but in terms of speed of execution of transactions and de-risking M&A, that was a really critical factor. The second point was the adaptability of governance on AIM, and particularly being able to utilize the QCA governance code at a point when the company was growing rapidly, and we had a number of governance structures that probably would have been frowned on the main list. The most obvious one being having an executive chairman within the business. And as I think that £500 million of equity raised, demonstrates, AIM offered us some really deep and accessible pools of capital, not just from sort of pure play AIM investors, but also from the broader investor community who were looking to back and invest in behind high growth businesses that had significant market opportunity, which was very much what the Breedon story was all about. I guess the logical next question is then, well, why move, and why think about coming away from a market that had served the group extremely well over a prolonged period of time?
And I suppose that's interesting, just to interrupt, because you did make that decision, and you at the time didn't have the catalysts that Stuart set out at the start.
Correct. I think there were a number of factors there. So the first was that we had become very sizable in AIM terms, and we've been talking with investors for a number of years that at some point and at the right time we would think about moving up to the main market. I think that whilst we were very successful and remain very successful in attracting domestic capital into the group, whilst we were on AIM, we were finding it more difficult to attract meaningful interest from overseas investors. And as we dug into that a little bit more, what we found was that whilst lots of overseas investors technically could invest in us as an AIM traded stock, what we were finding is we weren't being screened out, but we definitely weren't being screened in. And so if you're sat as a small cap institutional investor based in Chicago who can invest in small cap equities anywhere in the world, we as Breedon were very unlikely to come across their radar because they are looking at tens of thousands of companies worldwide potentially, and in operating their screening filters, a Breedon wasn't coming up. And so when we put all of those factors together, and the fact that we felt that in moving to the main market we could address some of those challenges, those were really the catalyst for us taking the decision to make the move at that time.
I see. And to elaborate on that, can you, if one of the drivers was that the overseas investor, can you say what that portion is on your register now versus 2 years ago? Has it proved to be helpful?
It has, but in that we certainly have a higher proportion of overseas institutional investors that now than we did at the point of making the move. Now, in part of that is almost the sort of the forced liquidity that came in to into our shares from those holders who are holding us as part of an AIM wrapper, effectively having to sell their shares. But I think it's important to stress that we didn't expect, and nor did we receive, a share price bounce purely as a function of making the move from AIM to the main market. We have seen an increase in liquidity as a consequence of making the move, but our whole thesis for coming up was not tied to any expectation that we would get a share price bounce purely as a function of making the move.
Yeah. Okay. And so people tuned in, as they used to say. Breedon 1.3 billion market cap. You have been higher, but still very safely ensconced in the 250. Now getting into the 250 is, I think, you could be 550 million market cap, and you're in there. Stuart, what's your thoughts on what James has said and the rationale and the story there?
It's all very logical, and I think all very true. You're basically opening yourself up to a wider range of investors. I'm not surprised you don't get a share price bump. I don't think anybody has really experienced that simply by moving listing venue. The company is still the company. The rating is still the rating. The fundamentals are still the fundamentals. In some ways, to follow on James's point, I think the interesting bit is about the recycling of the shareholder register. I don't think you should undertake the exercise without a very clear plan on how you're going to deal with people who need to recycle capital. I don't know if James did, I haven't looked at Breedon, but I think a lot of people nowadays combine it with some sort of authority to buy back shares or an on-market program to manage some of that initial liquidity, and then obviously marketing to people who can step in. I actually think, again, if I look at the broader context, that is a good thing for the market, because a lot of IHT funds are actually forced into buying other stocks on AIM that are in a position to want capital. So there is a little bit of a virtuous circle rather than vicious. To James's point, I wouldn't do it where you expect to automatically be screened in and have a whole ton of new buyers. You still have to work on finding the buyer, talking to people. You're just possibly advertising to a larger community. And then the final one I would say, to James's point, I think if you are capable of qualifying for the FTSE 250, then as a board it should be on your agenda. But it wouldn't necessarily be the case that forced you into doing or made a must-do option. I think going back to the size, and maybe we'll come back to it later, if you're not at the stage where you're likely to get indexed, and by indexed I would mean the FTSE 250 rather than the small cap, I think, again, I would be thinking through the cost-benefit analysis of doing it.
Yeah.
Because ultimately what James describes is that cost-benefit analysis for the board of going through the process. there is a cost to attracting more US investors, more global investors.
Well, I'll come on to cost. I mean, one comment from Claire, who's watching. I'm not aware of many more buyers for Main than AIM. I can think of one institutional investor who currently isn't buying new AIM holdings. Is there really that the Holy Land, the pool of extra investors?
Well, I think that's what I've just answered, James. I don't think there is a natural sort of, oh, it's moved from AIM to the full list. My goodness, there's an entire sort of untapped audience of investors in what is still UK small, sort of global small cap. It just does begin to screen you slightly better for a series of investors who might be able to do something. And as I say, I think there's an interesting bit around the forced liquidity. You are forced to go and market yourself with available stock to a whole bunch of new people, which I think can galvanize effectively liquidity in that turnaround. And where you have liquidity, you are likely to find buyers. Yeah,
I think there is a natural tension here. I mean, some people would say, and I don't think this is a Canaccord specific thing, sometimes the brokers talk their own book in this respect. Is that fair sometimes, or?
Very hard to comment. I don't think brokers necessarily talk their own book. I think this has to be a natural process. I mean, again, I would say this, wouldn't I? I think it has to be a process between board and broker with an honest assessment of the pros and cons for that particular company of going through the exercise.
Absolutely, but I've got a history of asking awkward questions, Stuart. They're not as awkward as they used to be, but I'd love to know. So we've talked about the investors, and I think there's something there that's come up in the conversation about this. About James, you talked about the conversation you have with them as you're approaching this kind of decision. So how does that go? Because I guess for some, it could be IHT related. They probably don't want you to go, and I think there's also part of the conversation here that at what point is there a formal vote or anyway?
Yeah. So we were very open whenever we were asked the question, and we were asked the question on a number of occasions over roadshows, that the listing was something that the board kept under review, and that at the appropriate time, we would almost certainly look to make a move to the main market. We felt that it was very important in our conversations, particularly with AIM funds, that we were clear on the point. We also announced with our full year results back in 2023 our intention to move up in advance of any shareholder circular being sent out or prospectus being published, because again we wanted to ensure that the market was informed of how the board's thinking had evolved and the board's intention. And then at the AGM that year, we had a subsequent EGM that put the proposal to make the move to a formal vote of the shareholders at that point.
So you're certainly a year ahead, really. I mean, there is the opportunity to have that formal view. And they're all still on your website, the prospectus, the scheme doc, the court. But it's got to be that longer. It's not going to be a surprise.
It shouldn't be a surprise, and I don't think it's fair to shareholders who have invested in your company if you're not clear that at least it's something that you have got under contemplation. And bear in mind, as a asset-backed, dividend-paying, cash flow positive business of scale on AIM, I think we probably inherited a sort of a disproportionate weighting of AIM wrapper funds compared to some others on the market.
Because okay, excellent. I got a lot of comments, and do you echo that, Stuart? I mean, it is it's clearly the board has to own the decision, but everyone needs to be communications.
I think to take your point of earlier, my turning up to a board and saying I've got a great idea. You should move to the full list, but don't worry about it. Everything will be fine. Let's crack on, and we'll all make some money. And I've got nothing better to do. Is just not how it happens. because ultimately, number one, the board is there effectively to promote the interests of the company. And so therefore, I think really as a backstop, the first question for the board is, when I do this, am I actively promoting the success of the company? And if I believe I am, what is the impact of that on different stakeholders, which again are contributors to the success of the company? Ultimately, if I have 35-40% of my company owned by a bunch of people who will be forced sellers on that move, then there is, or there should be, a large amount of consultation, announcements that you will consider it and consult, a plan for dealing with it, and that way everybody can buy into the process. I think the disaster is where people suddenly see on the screen and then have to react or feel that they are forced or that they've got to come out at the wrong moment. That's very difficult. So like all things in public markets, there is a large amount of discussion between company and multiple interested parties.
Yes, because clearly those investors using, with the IHT wrappers, I mean, this is not the only change they're dealing with this year, and it really is a.
Well, I think, James, to my earlier point, whilst you can't do a straight line, I absolutely think that the change in sort of inheritance tax rules had been a sort of bit where there's uncertainty, and it has led companies to think, actually, maybe we should deal with the IHT issue now because we haven't done so before.
Yeah. And of course, there's a whole other conversation about we talked about that recycling of capital, what that has done for the companies that are still on AIM, and whether that means that kind of the full impact of those changes we haven't felt in a way that we might otherwise have done.
Yeah, I mean, again, from a broking perspective, I think there are a number of companies out there that have been beneficiaries of IHT funds being recycled, and good high quality companies, I think, have actually seen share prices and ratings improved on AIM as a result of some of the moves.
Can we talk about the cost of the process? This has come up on a couple of couple of questions. I mean, I don't know if either of you can put a figure on this, because there's no, it's generally horses for courses and depends on, but certainly a million plus. Some people talk about 2 million, and I guess you have to weigh up. It's one of those cost benefit analyses.
I mean, James, you can probably talk to how much it costs Breedon.
It's a matter of public record for Breedon. So it cost us approaching £4 million to make the move. We were doing a number of things in parallel to the move, including moving our country of ultimate jurisdiction back to the UK. But it was not an inexpensive exercise.
No. And I mean, 2 years on, you look at that, and that's good value, is it?
Good value from a CFO is an interesting, from a CFO's perspective, is an interesting concept. But look, I think one of the things that we did following the step up is we did a review of whether it had delivered on our expectations. And what were our expectations? Well, the expectations was that it increased in liquidity, and that has undoubtedly happened. The expectation was that we would see a higher proportion of overseas institutional investors take a stake in the business, and that has certainly happened. The expectation was that it would raise our profile somewhat, particularly in the US, which we were starting to explore actively as a new market for us as a business. So on each of those sort of grounds, the move was a success, and we were very happy with our 15 years on AIM. We're 2 years now into our journey on the main market. And we're happy both with the outcome of that move, but also, how that has stacked up against our expectations going into it.
Yeah. And can we talk a little bit about the process? I mean, I guess some of this might have changed now because, for the points that Stuart, detailed at the start. But having talked to companies who've done this, there have been times when it's not been plain sailing. It's been more complicated than it needed to be. And I think even now with those listing rules changes, there are still points of friction.
James, can I?
Please.
I can pick up on that. I think the first thing to say is, again, I don't know if we said I've said it in conversation. When I did my first move from AIM to the full list, we as I said, we published a 6-page exempt listing document that was extremely straightforward and frictionless. The decision and the move were a 2-month process. So we are a long way, in my view, from a process that is quick, efficient, and not costly. So if we think about, and going to the costs, I think £4 million, there's an awful lot of other things involved. If we think about the process and who and what is involved, you can then start working through what you think the costs might be. Because the problem, in my view, is that it is an entirely new listing, whichever way you think about it. It is not a route that particularly recognises that you have a long history of being traded on the public markets by individuals and institutions alike. In fact, the only real recognition of that nowadays is that the accountants can incorporate, or you can incorporate by reference, your historical financial information. But then if you go through, you still have a sponsor who is required to make confirmations to the exchange, principally around your working capital, and therefore there is a large amount of work done on working capital, and your ability to meet the disclosure rules and financial position and prospects. I think if anybody's been through an AIM Nomad take-on recently, there is a lot of focus on FTTT by nomads. And I raise that because I think a lot of companies that have been listed for a while don't necessarily have all the information in the right place at the right time to meet a sign-off by a reporting accountant and a sponsor. So I think there is the documentation angle, which is relatively straightforward, can be pulled together quite quickly, and a prospectus is a prospectus at the end of the day. I think the real nuts and bolts comes in from the confirmations that need to be made and the work that sits behind those confirmations still. I definitely think most sponsors nowadays are not asking for a long form report, so that gets excluded. Most are not looking for full legal due diligence. They are prepared to accept a verification of the back end and then highlighting around areas for focus. But you're then going to need your admission admission or introduction agreement, that again is a suite of warranties. So there is an awful lot of process, and process, in my view, leads to cost around professionals.
Yeah. James, did it get harder from, different companies obviously, but from Timon to Breedon, was that noticeably harder?
I think it was arguably marginally more straightforward in that, when Breedon made the step up, we were allowed to incorporate documents by reference, which wasn't the case back when Timon made the move. But fundamentally, we were regarded by the regulators as a new entrant, and therefore, we had to go through what was essentially a micro IPO process, despite the fact that we have been listed on the London markets for sort of 15 years. I think the other part of the process that people need to be open to is it's not as straightforward as you turn up on the main list and you're automatically included in the relevant index. The index rules and the index process sits around fixed corporate quarterly review dates, and so you can end up with a gap when effectively your AIM holders are having to sell, but the index funds are not yet in a position to have to buy.
Thank you. And I think you've touched on this, but the review of has your board reviewed the decision in terms of a post-mortem, and whether what you thought would happen did actually happen?
Yes, and I think the one thing that that we that I think we were less prepared for was that gap in indexation, and the fact that that would take as long as it did, for us to be included in the indices. I think we moved up at the back end of May, and we were only included in the indices come September. But other than that,
actually some people moving now are that's one of the points, isn't it? How long it takes to get that index inclusion.
Yeah, but other than that, as I said earlier, I think the objectives that that we had set out, and the criteria that we had defined, we feel comfortable that those have all been met.
And one question now about for you about retail investors, the proportion that own shares in Breedon, at least partly for IHT purposes, and how did they respond?
I mean, it's a bit difficult to disaggregate, to be honest. We have always had a relatively significant retail following as a function, I think, of that establishment as a cash shell. Quite often, cash shells get relatively high levels of publicity, and retail investors follow in as a consequence. And we still retain a good and sizable retail following even after the move up to the main list. So to disaggregate how many people had to sell because they were holding Breedon shares purely for an IHT benefit is quite difficult to do, as opposed to obviously those institutions that are holding as part of an AIM wrapper who clearly were in a position where they had to sell.
Stuart, we talked about the rules and the push and the pull. I mean, clearly, AIM is reviewing its rules right now. We should hear more from the LSE on that next month. What does that do to the trend, do you think?
I can see Claire N's question as well. I actually don't think it necessarily changes the momentum for moving. I think what it does do is effectively allow AIM, and obviously this is a personal view, to sort of reiterate its raison d'etre and go back to what James and I have both described, which is a market that is very much there for high growth businesses that can take advantage of an alternative governance regime, explain or comply from the QCA, can raise capital easily, can develop as a public company, and then at some point in the future make that decision as to whether it moves to the full list. Again, to the point, if I was on the board of a company, I would be extremely wary of a broker simply turning up and you should do this without a huge amount of discussion, cost benefits analysis, etc. So I think AIM's rule changes will firmly put it back in a place where it can be for the benefit of growth companies. If I just extend that point one further, because someone's asked about corporate governance, one of the problems of, in my view, AIM at the moment is it is trying to be too many things to too many people because of the way that it has evolved. So you've ended up with some very large companies that are effectively subject to the same regulation and the same explain or comply as some really quite small companies. And again, I think there is I wouldn't want to see a two-tier system or anything like that, but I think it allows you to get to a point where companies are similar rather than trying to speak to multiple audiences.
And look, it's our code. I mean, we wouldn't want to see a two-speed system either. And as in our feedback to the AIM discussion paper, if you were to have a two-speed code, you pretty much would need a two-speed market. There is one on Aquis. There isn't one on AIM. We hope that what we put out there is still sufficiently flexible, and that's a lot of the feedback that we get back.
Great. I think then again, sort of moving that on a step.
Yeah.
The problem then becomes effectively that the proxy voting services, which are effectively institutional in nature and advise institutions, are then effectively very interested in the top end of AIM and how that corporate governance works. And we know for a fact there is a huge amount of friction around how they recommend people vote versus how the company actually operates and what the board structure is.
Yeah, I mean, look, we've said we weren't wholly satisfied with the review of the UK Stewardship Code, There are some dedicated principles there to proxy advisors, but really, we don't think they are. You can talk about the relationship between the investors and the proxy advisors that they employ, but if you don't add the companies into that three-cornered conversation, no companies, no point. The dialogue, the communication, the nuance, it's really lacking. And to the extent that you would think a small company that is getting on the radar of the proxy advisors, that's something of a badge of honor. They have reached a size and scale, but actually it's not a very good quality relationship at all. And it's something for those companies that have still quite a tight internal resource. There really is no right to reply. Yeah. It's quite dangerous.
Yeah, no, 100% agreed.
James, do you want to follow on this point, the points that Stuart made there? I mean, particularly governance and rule changes.
Yeah, so I mean, I sometimes describe that our best time as a company from a governance perspective when we were still on AIM, but we were acting as if we were on the main list, because at that point, whilst if we did fall short of the UK corporate governance codes, it didn't matter, but we were really trying to act as if we were a main market company, and I think that the key piece of advice I would give any board or any company that is contemplating the move up is that they do get main market ready. I think if you try and get ready at the point that you're making the move, you're going to struggle to get through FTTT. You're going to struggle to act as a main market company once you get there. And it's not just as a function of, say, looking at your board composition. It goes much deeper into the company than that, particularly around your approach to risk and control. And quite often, smaller companies have much more flexibility and adaptability in terms of how they manage their business on a day-to-day basis. Risk and control takes on a whole another level of importance once you make that move up to the main list. TCFD is now a very significant part of any main listed company's self-analysis and how that is communicated out to the market. And I think the other point is that your audit changes in nature, and on a practical level, you can realistically expect a review of the regulator of your accounts in that first year following a move up. But you can also expect your auditors to be audited in that first year following the move up. So that period of preparation, that period of starting to conduct yourself as if you were on the main list, I think is really, really important, because it gets you into the mindset of being a main market company and acting like a main market company at a point where, in many respects, it doesn't matter if you fully achieve your goals.
Yeah. There is something I wanted to point out. There's a paper that's coming out from the Investor Forum next week, which is looking at smoothing some of the points that, as you referred to, smoothing the path. If you like, and it's something I was going to link on later. But some of their suggestions include that phased approach to governance, particularly around maybe 12 months phasing to get on top of TCFD, because I know that's I know it's been in place for a few years, but it is a headache even for those companies, I think, who've done it for 2 or 3 years. So it can be a shock to the system. Another one is proposing the relaxation to the requirement for working capital, for a working capital report. Transition timeline, perhaps 6 months grace, during which time a company moving from AIM to main still qualifies as an IHT exempt investment. Are those things that would be useful, things that are lacking currently? Either of you, Stuart?
I certainly think a transition that doesn't mean people are sort of forced out is good, although on a practical basis, all of them have to transition sort of carefully anyway. You can't just dump all of your stock on the market, but formalizing it would help. I think working cap is an issue every way you put it. It's been interesting if you look at AIM and their consultation. I think the UK is the only developed stock market that actually incorporates working cap statements into documentation. It's clearly valued by institutions. It's potentially not as valued by the company.
Yeah.
I think the question, the UKLA, the FCA have been very, very clear in their response and looking at the new regimes come in, POTAR or whatever it's called. They've been clear they don't really want to mess with the working capital statement because whatever you replace it with could well become more problematic in terms of the actual work that goes into it and the actual description of the risks, etc. So I think it opens up a lot of discussion, and it's a discussion AIM are currently going through in terms of their overall changes as well. So yeah.
Yeah. Okay, James.
Yeah, I mean, look, I think that so anything that helps smooth the path for those companies that are seeking to make the move, I think is a good thing, and I think some form of transition periods, particularly around TCFD, may not be a bad thing. Equally, I think any company that makes the move has to make it in the full and certain knowledge that ultimately they've got to get to a position where either they are complying with the UK Corporate Governance Code, or they are explaining fully as to why they're not in compliance. And attached to that is the role of the proxy agencies that we talked about earlier, and they can be pretty unsympathetic to the explanation. So you have to be prepared as a board that if you're not going to comply, even if you feel as a board that there are extremely valid reasons and that in doing so, you are promoting the ultimate success of the company for all of its stakeholders, that you can expect in the event that you're not compliant, that you may receive votes against individual directors, you may receive votes against specific resolutions. You may find that some shareholders elect no longer to hold shares in the company.
Mm-hmm. And it's always good to find that out on a 3 a.m. email from Manila or somewhere, isn't it? Just at this final point from the investor forum piece of work on the communication point, and James, you touched on this. Well, broadly, it's greater clarity around the steps needed in order to undertake the transition, and they allude to the index admission timelines, absolutely, and that's still something that I think is being worked on currently, but also clearer comms between the exchanges. And I thought this was interesting because, two exchanges, yes, within the same building. So I'm surprised. What is that communication that a company would need from the AIM side of the desk to the full list side of the desk? Stuart, maybe.
I suppose I'm struggling a bit with where that communication would come. Ultimately, AIM is an exchange-regulated market, and so the FCA provide oversight.
Yeah.
The full list is obviously regulated by the FCA. I'm not really sure there's much communication that's necessary to ensure a smooth transfer between the two.
Okay, maybe I'm misreading it. Maybe it's the communication between the exchanges, the company, advisors, and investors. So it's the whole.
Yeah, the whole.
Yeah. Okay.
Yeah, I may have missed the point. In which case.
I obviously stopped reading partway through the sentence. That might be it, which is a terrible habit. We've got one more question, James. Your thoughts, and I think you can read it. Your thoughts on the process as a look back. I mean, is there anything that you would have done differently with hindsight?
I think that the one thing that I think we would have done differently is we would have paid closer attention to the precise interaction of the indexation timetable. Right. The extent to which into which our timetable didn't fully interact with the index rules was not something that we fully grasped. I think everything else, you can always, do more preparation. You can always do more thinking about what life would be like once you make the move. But I think in the main, because we'd taken that active policy, really 3 or 4 years before we made the move up, that we were going to conduct ourselves as if we were a main list company. We were going to, whilst our public disclosure would be against the QCA governance code, we were also going to do the cross-reference to the UK corporate governance code. We'd made significant investment in our risk and control function. We'd made investment in our company secretarial function. And we'd also made investment in sustainability and in the aspects of TCFD that would be likely to come across our desk. I think all of that served us very, very well as we approach the point of taking the decision as a board that we were going to make the move.
And Stuart, do you know, testing you now, I mean, that I think that point about the index admission is being smoothed out, isn't it?
I'm going to say I don't know. I'm really sorry.
And I only asked you because I didn't know.
No, one would assume it would be, because ultimately it is something that people look at.
But it has come up. It is interesting. Even with this cohort, it is something that's come up. I know we were late, we were early.
And I think it's important that I think there is a difference. I would posit between a company that has been listed on a London exchange for a number of years, with a clean track record, clean audit reports, etc., remain fully, banking covenant compliant over that period of time, making the move from one market to another, and then effectively not being eligible for even index consideration for an extended period of time, compared with a new company coming to market for the very first time as part of an initial public offering process.
And just finally, I think for me, we've kind of alluded to it, but going through the process, were there significant board changes that need to be made, or is it a case of the existing board, genning up on the new market?
No, so I mean, we spend a lot of time with our sponsor, making sure that the board were fully briefed on their new responsibilities, and making sure that, in particular, the non-executive directors had an opportunity to discuss and debate how their directors' responsibilities changed as a function of the move up. But we had, as I said earlier, we'd largely looked to conduct ourselves as if we were a main list company for a number of years prior to making the move. So board composition was something that we had addressed. Board committees was something that we had addressed. And that compliance, not just with the QCA governance code, but also with the UK governance code, was something that we had addressed.
And Claire makes the point on the chat. Yes, the index admission much faster within a few days now, as opposed to waiting months. So thank you for that. I think we've covered it from all angles. So any final thoughts? I think it's really really interesting to get under the skin of what has happened, what could happen. The pros and cons. Actually, maybe a question to just a final thing. There is a theory that AIM prospers if that path through is clearer and simpler. And there's also a theory that if all of these markets work together in harmony, then companies are more likely to remain listed in London for longer. Do you subscribe to both of those points?
From my perspective, I think it's absolutely essential that we have two markets that work well, but also work in harmony. And I think that's a really important consideration here. I think that having a nimble, dynamic, flexible market particularly for smaller growth companies is a really, really important element to the capital markets ecosystem. Equally, I think having a developed main market that can attract international companies of significance, and where people choose to be listed and choose to be invested, that's also important as well. But the differentiation is also critical, because I think that if in coming onto the main market, you are on the same market as a BP or a Shell or an AstraZeneca, which are companies potentially of very, very different scale and resources compared to some of the companies that we see traded on AIM.
Yeah. And Stuart, before you answer, I might as well throw in what Liz has said, which I think you can read also. Given the number of take privates, the prospective risk of AIM to Pisces moves what will be the enduring sticky point of attraction regarding the main market. Well, that's the second hour, I think.
I just say there's an awful lot in that. So I think I would summarize it to agree with James. Number one, you need to see that sense of progression, which I think has been lacking. And it allows both markets to then speak to their own strengths. Number two, I think Pisces is interesting. There's a whole thing there. I'm not sure I necessarily see things moving from AIM to Pisces.
No.
I think Pisces is an attempt to effectively attract private equity-backed businesses to see if you can provide trading facilities for them. I think there's an amazing opportunity for AIM with the current consultation to re-establish, as I've said, its raison d'etre. I mean, I think overall for all of us within the community, the key point is that globally, and particularly in the UK, there are less and less quoted companies. The only way that dynamic changes is if more and more companies float. I think getting flotations out of private equity is difficult, although we'll see how that changes given sort of the backdrop, debt profiles, etc. But you then have to make it easy and enticing for companies to admit to AIM and begin to make that progressive journey. And to the final point on the question, what is the enduring quality? At the risk of sounding sort of slightly Rule Britannia, whatever the press, a full listing on the London Stock Exchange is still a badge of quality. It is still a very, a very good investment criteria, and it attracts a huge amount of investment capital globally.
Yeah.
I don't think any of that changes with the current moves, and hopefully it will reinforce it.
And actually that point on the profile, the kite mark of a London listing, and how that plays overseas is something I posted on this morning. It's a very interesting theme that came out of the MHA maiden results a couple of weeks ago. Look, I think we've almost filled the full hour, and I think it's been really helpful conversation. So thank you, James. Thank you, Stuart. This will replay on YouTube. We have more webinars coming soon. We have EDI with Simon Fanshawe next week. Please look at our website for details about that. And please, if you're, please get in touch with thoughts, ideas. And if you're not a member, please become one. Thank you both.
Thank you.
Paul, back to you.
Fantastic, James. Thank you. And thank you to the guys as well. On behalf of the QCA, we'd like to thank you for attending today's webinar. That concludes today's session, and good afternoon to you all.